Hi, this is your quick recap for 2015 and a little bit about what we see coming in 2016. 2015 has turned out to be quite a bit like 2011. If you'll remember 2011, the year started out pretty good, and then we had the Greek crisis, the first big one. In the summer, the market dropped over 20%, pretty much in a month. And by the end of the year, you ended up with most asset classes down for the year. The S&P, I believe, was up a little over 2%. That was really the only thing that made any money whatsoever. 2015 is very similar. No matter where you've taken risk this year, as an investor, if you're actually doing some sort of asset allocation, you're going to end up being pretty flat. Once again, the S&P 500 is up 3.6% of the year through December 4th. But that's a very top-heavy number. The top 10% of that index, so about 50 stocks, are up 8.25%. The other 450 stocks in that index are down quite a bit for the year. Very similar to what happens at the end of market cycles like 98 and 99, where you've had a big long run and everybody keeps piling into the last few stocks that are working, and you end up owning a lot of stuff that's not working, and the only stuff that is working is super overvalued kinds of names. The rest of the market, small caps are down 58 basis points for the year. The MSCI World, not including the United States, is actually down over 3.8%. That's due in large part to emerging markets and international stocks struggling all year long. If you look at a global index like the MSCI World Index, which includes the US, which is what we like to do at Tectonic, that is essentially flat. It's down 1 basis point through last Friday. So gone through the whole year to end up exactly where you were at the start. What caused this? Well, this year the culprit was China. The market was kind of meandering along, and China came in one Sunday night and lowered their currency by 3%. And kind of caused a big tizzy in the currency markets. That lasted over a month and a half. Our stock markets dropped a lot, and you had a lot of volatility, and things have since rebounded a little bit and kind of ended up back where we started before that. But the volatility has remained day to day. Things are very choppy. Current commodity markets, you had oil drop 46% last year. It's down 27% through Friday. It's down another 4% today as I'm filming this. Which doesn't really speak good things about kind of the overall health of the global economy. So 2015 has been a very mixed bag, both on an economic data and a market, in the market sense. Even the bond market, bonds are up 69, 70 basis points in the United States. Globally, they're down, and high yield's down 2%. So if you have any kind of mix of a bond portfolio, you're looking probably at a flat return there as well. Kind of on the good side, our economy is still growing, and growth's actually been a little bit better this year than projected. Jobs data has continued to be very strong. On the negative side, you're starting to see that data maybe top out. The ISM Manufacturing Index dipped below 50 for the first time since June of 2009 at the end of November. Generally, when that number's over 50, that means you're expanding as an economy, and when it dips below 50, it means you're starting to contract. And it's usually a pretty reliable indicator that you are going to have some sort of a recession sometime in the coming months, 18 to 24 months out. It's not a definite indicator that something's going to happen tomorrow, but it is kind of a really good thing to point out and say where we are in a business cycle, in an economic cycle. What 2016 is going to look like is largely going to be dependent on two things. It's going to be dependent on what the Fed finally does with interest rates, and kind of with the continuing troubles for China and Europe and some of the other economies around the world that don't have a lot to do with us on a day-to-day basis, but make a big difference in your overall markets and really what your portfolio is going to do, on a yearly basis. The Fed's been telling us for 2 years now that they're going to raise interest rates, and they keep putting it off and putting it off and putting it off. They've kind of backed themselves into a corner now where it looks like they may even do it this month, shortly after this video posts. The odds on that are probably 60%, if I was guessing myself, that they'll actually hike rates before Christmas this year. how the markets are likely going to be very volatile after that happens. That's going to be the first interest rate hike since before all the financial crisis in '08. It's been a long time since we've had a Fed funds rate, or much less rates going up. So the markets are going to act very funny. You're likely going to see a lot of volatility in tons of asset classes in your stocks, and certainly in your bond portfolios as well. And that's also going to have a dramatic impact on what all these other economies around the world do. You know, everybody's been printing money all these years. Everybody's coordinating with other central banks what they're doing. And when we raise rates, it's going to cause our dollar to get strong, and that's going to have effects on Europe and China and Japan and all these other economies. And central banks are going to have to follow suit.